passive overdose that our industry has led everybody into, they are unwittingly taking on a lot more risk than they imagine. Welcome back, everybody, to the latest installment of the $1 Million Question. I'm Stephen Weitzel, managing partner, Reveille Wealth Management. Thank you for joining us so much today. So, again, the nature of our show a little different from some of the other programming you're going to find on Stock Market TV. We're not necessarily talking about trades that we're putting on. We're talking about things that are more planning oriented. We're talking about some things that are going to structurally impact your investments. And we will be joined today by my friend Larry McDonald. I'm very happy to have him come on the program because Larry's background, he's seen a lot of things in this business. I've been blessed to be able to be mentored by him over time, but he's been there since the crash of '87. He was there in the dot-com bubble. He was famously at Lehman during the financial crisis, wrote a best-selling book about it called A Colossal Failure of Common Sense. He's most recently penned a book called How to Listen When Markets Speak. And the premise being that where the markets are headed over the next decade are not reminiscent of what they have been over the last 10, 12, 15 years. Now, I wrote a white paper called Pavlov's New Dog that is right up on a year old at this point, where I was effectively examining the same premise that investors are conditioned beings and they go and allocate their capital into areas of the market that they feel have treated them the best. And that Pavlovian response will ultimately lead them to taking on a lot more risk than they really appreciate. And ultimately, when things don't go the way that they have planned, right, when the outcome is different from what they have experienced, they don't know what to do. And that it's going to take a long time to be able to unlearn the behaviors that have been reinforced. And there are some very long-term trends that investors or our industry as a general rule have adopted as the gospel. And so some of that being that if you include fixed income in your portfolio, you're going to help to reduce risk. Well, that was the case for 40 years when from the early 1980s through 2021, we had a declining interest rate environment. Having bonds in your portfolio was a way to help minimize the amount of risk that you had relative to the stocks that you owned. But 2022 was really the first shot across the bow where we saw that both stocks and bonds could be down by double digits in the same year. That had never happened before. And so those closely held notions are getting challenged. They're getting upset. One of the other ones, and we talked about it on our show a little bit last week, is that the concentration risk that we see in the markets today are where we have the 10 largest stocks in the S&P 500 account for over 40% of the total market capitalization, that is going to pose a risk. And many investors who presume themselves to be diversified because they own an S&P 500 index fund, how does that not sound diversified? It's never been less diversified. And that sword, it cuts both ways. It has maybe been a leader in your portfolio for the last decade or more, but it isn't always going to be that way. And so some of the stuff that we talked about last week, I actually got an email this morning from Alfonso at All Star Charts, If you're an All-Star Chart subscriber, you might have gotten the same email. I'll just share it with you here quickly. You throw that up, Spencer. If you guys are a subscriber to All-Star Charts, you're probably getting the same thing. Well, Fawn stole my chart from last week where we were looking at this growth value ratio where growth stocks have been outperforming their value counterparts for 17, 18 years, maybe it's 20 years. It's a long time. Obviously, there were periods where that was not the case, back here, 2021, 2022. But that ratio of growth to value, and as this ratio has been moving higher with the growth stocks in the numerator, this is growth stocks outperforming. And they've gotten to this key extension where we would anticipate some resistance to show up. And it really looks like, and what I said on the show last week, is that I think we need to be on failed breakout watch here. And that if we started to see this ratio back below these levels, guys, growth stocks have never been as expensive relative to their value counterparts as they were at the end of 2025 and the beginning of 2026. And the question that I'm going to have for Larry as he comes on here is 2026 really set up to be a house of pain for investors? I kind of worry that in a lot of ways that it could be. And it's going to be because the way that many investors are passively positioned, kind of buried their head in the sand, have way too much exposure to U.S. equities, and kind of by default, more of the growth stocks, that those things, they're not guaranteed to rise in value. As a matter of fact, they can fall, they do fall, and we are starting to see that ratio of growth to value stocks retreat backwards, where those growth stocks are underperforming. And so that could be a house of pain for investors. The other side is that this rotation that we've started to see, that Larry will be able to talk about, into things like metals and mining, things that were really hot last year, as maybe the market that had been positioning itself for AI, the AI build out. And so everything that goes into the data centers, but it requires a lot of things like copper. And so those types of commodities, they soared last year. Obviously, we saw record high prices here recently for gold and for silver, things that several years ago people didn't want to touch. But they are red hot right now. And my concern for people is that they are going to find themselves overextended in those things. They're chasing the hot money. These people would have been chasing the pharma stocks probably back in 2021 after they had gone on a massive run. Be careful of following the Johnny come latelys on things where they think, you've got this paradigm shift going on out there. You do not want to get caught off sides there. So that's where I believe that 2026 could be a house of pain, maybe for a lot of investors out there. Now, that doesn't mean it's going to be the case across the board. I still believe that there are a lot of opportunities out there, but they're in the things that are still under-owned and they're underappreciated. I saw a chart recently looking at the commodities index as a whole, and based on asset flows, what are the allocations that people have to commodities in their portfolio? And it's kind of not surprising that at the end of the last commodity super cycle back in 2011 or so, that was the last time that people had, call it a meaningful allocation to commodities in their portfolio. They owned about 11% of their portfolio in commodities just based on what flows were. That number is now 3%. right? And based on my experience, people either own commodities or they just don't have them at all. Because why would they? They've just been underperformers, and they've kicked them out of their portfolio. Large firm that I used to work for back in 2020, as part of their house models, they removed a commodities allocation entirely from their client models in March, April, May of 2020, because and it was absolutely the wrong time, right? But they succumbed to client pressure of, why are we owning this thing? And especially considering that energy is such a large piece of that index, uh, people were screaming at the time, we don't want to have exposure to energy. Why do we have exposure to this kind of stuff? And they kick it out at the wrong time. So, um, but as Larry will join us today, so we are going to be giving away copies of his most recent bestseller, How to Listen When Markets Speak. So if you are interested in getting a free copy of his book, send us an email to info@reveillewealth.com. But I need you to stay to the end of the show. I'm going to give you a key word that you got to email in to be able to secure that copy of the book for yourself. So now, we have asked on our last couple shows, really last week was the first time we said we want to start doing a mailbag where people can send in questions of issues that they're facing personally in their own wealth journey, other financial advisors. If there's kind of a case study of, hey, I've got a client with this situation, maybe I don't really know what to do, or would just like to have a sounding board of some options, send us those questions, send us the details of those types of things. Obviously, leave out things like names and values and stuff like that, unless the value is critically important. But send us an email, info@reveillewealth.com, and we'll try to pull some of those out and talk about them. I'll give you a quick little case study of a conversation I was having recently with a client who's been very successful, prospective client, I should say. He's been very successful in his life. He's got about 30 million in investable assets, does very, very well on an annual basis, and he's going to continue to work. And one of the first things that I said to him is, if you're at 30 million in assets right now, but you're a saver and you're making a lot of money and you're going to be continuing to add to that nest egg over time. He's in his early 50s. The big, beautiful bill, it made permanent an estate tax exemption level at $15 million a person. He's magically at this $30 million number right now, has done no estate planning whatsoever. And I said, look, I'm happy to talk to you about things related to your investments, things that we think that we like right now in the market, how we think you need to be positioned. But if we don't take a step back here and have a conversation about the way that your wealth is positioned, the way it's titled, the way it's registered, that's going to create a problem for you potentially. And you need to see an estate planning attorney ASAP, because right now, every incremental dollar that you earn and save, should something happen to you, he lives in California, this guy, more than half of it is going to go to the government, federal government, to the state government, more than half. It doesn't matter how good of the investment selection might be that we could help him with. That's something that you want to avoid. So we need to try to have a conversation with him over the structure of his wealth first and foremost, right? So big, beautiful bill went into effect last year. There were a number of things that for investors, for financial advisors, key levels that you need to be aware of. It just so happened here early 2026, I run into one of these situations where somebody's net worth, between him and his wife, they have exhausted the estate tax exemption level. They need to look to do some estate planning where they can remove some assets from their estate, get that future appreciation out of their estate. So the growth that they experience in that isn't going to have that massive estate tax levied on it. So again, you have cases, you have questions about these types of situations out there, send us an email, info@reveillewealth.com. We want to be able to help you reach through those things. So um, we're about to bring Larry on. We're excited to have him. But again, if you want a copy of Larry's book, send us an email, info@reveillewealth.com. And I'm going to need you to stay for the end of our conversation, get this keyword. First 6 emails that we get with that keyword, we're going to send you a copy of Larry's book. So, Spencer, how are we coming with getting Larry here? All right, we're working on it. We got a couple little technical difficulties with Larry's camera. We're working that out. So stay with us. While we're waiting, I'll ramp on this. New York Giant fans, we are in our Harbaugh era as of today. I think that's exciting. The thing that I always find interesting about these sports franchises, and everybody wants to win. Tom Coughlin wins 2 Super Bowls, and then things, backslide a little bit, and we fire him. And it's like, why? Because we aren't winning a Super Bowl again every year. We know that we're not going to win a Super Bowl every year. But Doug Peterson gets fired from the Eagles a couple years after winning a Super Bowl. I'm not going to say a whole lot of kind things about people from Philadelphia, even though one of my best friends, COO of Reveille Wealth Management, Michael Benicelli, he is from Philadelphia. He's a diehard Birds fan, but he and I don't talk on Sundays during the fall for that very reason. But I think Harbaugh is a really good hire for the Giants. I didn't really know what to think about Dable. I mean, he did great as an OC when he was in Buffalo, but it's still a game, even in the NFL, man. It's about Jimmys and Joes, and I'm just incensed. I've been incensed at the Giants front office for a decade, ever since we drafted Eric Flowers. I mean, it's been downhill since then. And look, he was a giant of a human being. And when he was at Miami as a left tackle, nobody was getting around him. Because there just aren't that many big dudes that you're going to come across in college. But by the time you get to the NFL, you've got elite guys coming off the edge. His footwork was terrible. We never developed him. Wasted God knows how much money on him. And it's been downhill ever since then. But you know what? New era. I'm excited about it. Let's bring Larry in. Let's get this started. Larry.
Hey.
How are you, man?
Thanks. Hi, Stephen. How are you, my friend?
Hey, doing well. Thank you so much for joining us. So, I previewed the audience a little bit here, Larry, about our conversation and our background and the amount of time that we've known each other and the things that you've been able to teach me. But our conversation today is going to be about, is 2026 set up to kind of be a house of pain for investors? And I know in your most recent book, How to Listen When Markets Speak, and we're going to be giving away some copies of those to folks. If they're interested, they'll send us an email. We're going to give them a code word at the end of our discussion today. But it's a phenomenal read. But your premise in the book is that where the markets are going over the next decade, that's not reminiscent of the last 10, 12, 15 years that we've seen. Can you explain that?
Well, so in the book, we pound the table on hard assets. So not just gold and silver, but copper, platinum, and palladium, um, Alcoa, and aluminum. So it's Neil Ferguson wrote the forward, and his point is this is not a bearish book. It's a book that's extremely bullish on hard assets and bearish on financial assets. And when you go through a 30-year disinflation regime, it creates a psychology across the entire investment community that you have to be long, growth stocks and bonds. And
Mm.
what's happened since 2022 is there's been this sticky inflation. If you look at any list of items, the cumulative inflation since 2022 is 20, 30% across autos, across restaurant. I mean, everything you can think of. So the politicians want to, whether Republicans or Democrats, they want to really, poms in the air celebration of like inflation normalizing. It's complete bullshit because the average person is dealing with inflation over 3, 4 years that is normalizing at a very high rate of
And it's
like a high,
cumulative, right? It's
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 cumulative.
cumulative. Yeah.
Right, exactly. You don't care if like, oh, the last couple of months you came down by a little bit, your average person. So what happens with an investor that's in bonds, like say Japanese bonds, you've got higher bond yields, lower bond prices for since 2022. Same thing in the UK, same thing in the US. And so there's trillions of dollars in bonds, and that some of that money's coming out of bonds and going into hard assets. That's why the COPX is destroying Nvidia. I mean, we literally wrote a chapter on copper and the power grid and the data centers in our book, especially in the paperback, which is updated. We recommended the COPX in the book. The book's published in 2024. COPX is up 114% year over year. It's a basket of copper names. But on the other side of the coin, there's 32 trillion in the NASDAQ 100, maybe almost 33. So 32, 33 trillion in the NASDAQ 100. And it's crowded into all these idiotic, moronic AI stocks, right? That are priced for
Absolute
820.
perfection.
Well, yeah, you need 820 data centers to be built in 5 years without any problems with the power grid, without any problems with NIMBY, not in my backyard. Again, 20 other things. And so if that build out just goes from 820 data centers to 600, then a good portion of the S&P is probably going to drop 50%. And
Wow.
once again, you want to be in a portfolio, and you just look at it since October. The market's starting to smell this out. And JC Peretz tweeted this last night. The FANG stocks are down 2% since October,
Throw the
and
chart
hard
up.
assets are ripping, and value stock. The market's broadening out. There's so many great companies like Diageo. You could buy Diageo below the 200-month moving average. One of the great brands in the history. I mean, Johnny Walker Blue, Guinness, uh, Smirnoff. I mean, there's so many great stocks in the market, but everyone is long the same idiotic portfolio. Passive investing is the most moronic. It's going to completely blow up, right? You can't have
Mm.
two stocks that are 14%, 15% of the S&P. It's idiotic. And if you're a fiduciary, if you're a financial advisor, you need to warn clients about that because the last 30 years, the top two stocks in the S&P were always 6% combined, right? So we've
Yeah.
gone from top two. No, you're a fiduciary. I mean, I've recommended, I've referred clients to you over the years, and I recommend you as an advisor. But I've always wanted to ask you that, like, how do you deal with that as an advisor? How can you recommend the S&P 500 if someone's going to put $1 million in the S&P, 150, 140,000 is in two AI stocks?
Yeah. And so that's that, as I was kind of previewing you coming on here this morning and then our show last week, we were talking about the concentration risk in the S&P where the 10 largest names are over 40% of the entire market capitalization, and way too many investors out there, they believe that simply because I'm buying the S&P 500 index, how can I not be diversified? And the reality is they've never been less diversified today. And so it's something that we here at Reveille have been sounding the alarm about for a long time. Uh, I've seen you talk about how Jack Bogle, he never intended, right, founder of Vanguard, he never intended that passive investing would turn in to what it is today. And Spencer, throw up this chart when you get a chance. But Larry, one of the things that I know that you've taught me over my career is that there's an incredible amount of money that can be made when you're positioning in things where the sentiment and the price action where it's been terrible, right? The energy stocks back in 2020, 2016, before then, maybe the tech names in 2002, that when everything is terrible, that there can be a lot of money to be made when things go from terrible, uninvestable to it's pretty bad. On the flip side here, how much money, and you've already kind of hit on it, how much money can be lost by people when the sentiment goes from unbelievable, you'd be foolish not to be positioned in these things, to, it's not quite as good as we thought. How much money is going to be lost because it's not as good as people think?
Right. And we've already seen a little taste of that with Oracle and Meta, right?
Mm, yeah,
And we've seen that, a taste of that with Tesla since 2021, right? It took years to get back to that high. Yeah, and
sure.
so we're coming into that. That's the Nvidia moment that's coming. And but the stat that blows me away from the book is that in that higher interest rate, higher inflation regime, once you're in that fourth, fifth year, by 1980, so think of the 1968 to 81 portfolio, 50% of the S&P was in materials, energy, uh, and industrials, and 50%. And right now that's like 14. So in the
Mm.
book, we're not saying you're going to go back to 50%, but are you going back to 24, 25? Yes. And the
And that's a
stat
big
is,
move.
here's the stat.
That's a
So
big
here's the
move.
stat. So 11 years ago today, there was 4 trillion in the Nasdaq 100 and 3.4 trillion in energy, oil and gas. 4 trillion, 3.4. 4 trillion in the Nasdaq 100, 3.4 in energy. Today, there's close to 33 trillion in the NASDAQ 100. That's just paper certificates, right? Financial assets, 33, 34 trillion in the NASDAQ 100 and 2.8 trillion in oil and gas. 2.8. So you've gone from 4 to 33, and you've gone from 3.4 trillion to 2.8. And
Mm.
that tells me that, especially after you just had this incredible move in aluminum, we recommended in our trade alerts last year 5 times Alcoa and the copper names. We're lightening that now, but we want to be buying your Patterson Energies, PTEN, your Range Resources, RRC, your Anteros. The free cash flow yields on these stocks are like close to 10, 15% in some cases. Companies are buying back 10% of the outstanding shares. They're generating so much free cash that they're buying back stock. So you have the company buying back stock underneath you. But here's the weird thing that I want to ask you, Stephen, is that supposedly the reason why bare natural gas is under some pressure, number one, the weather patterns really were a little warmer, so that caused a little bit of a puke. But supposedly the data center build out is slowing down. If there was a big report out, we put it in the Bear Traps report last night. You should share it with everyone, and it's in
Yeah.
this morning's Bear Traps report. I know you get that. So look at that. So this like in-depth study by a major player in grid construction analysis that focuses on this slowdown in the build out. So let me get this straight. So that's bearish for natural gas, but the semiconductors are up another 3% today, near all-time highs. So something is wrong. Now, I know
Yep.
TSM came up with numbers last night. They were good. But remember what Stan Druckenmiller always said. My favorite line. Do you remember Stan's favorite line? about,
Tell me.
it doesn't matter what the company's earning today. It's irrelevant. You got to look forward 18 months. And
Yeah.
that's where the stock's going to be. Any jerk off analyst that's talking about Taiwan Semi or any semiconductor stock or Nvidia, it's all backward looking. These guys were so negative on these companies a year and a half ago. Okay. Their price targets were like 60, 80, sometimes 70% below where the stocks are now. And
And they
and
and
to
they've been chasing it up the entire way.
chase it up. And your point is the best point of this whole program, is that when you go from a bar of the outlook is really that spectacular to just marginally like excellent, then you can have a 30% drawdown.
Yeah. And I think that very few people are prepared for that. Spencer, throw the chart up here one more time so we can take a look at it here. This is just another view of, we were talking about what growth versus value looks like, but the Mag 7 relative to the S&P is starting to roll over. It's, broken down through these former highs, an area that apparently had tried to turn into support. It's not been able to. And we have no idea, Larry, how far this thing can come down. But, what we talked about in our recent podcast here at Reveille, where we're talking about, are we in an AI bubble? That the first sign of what that would look like would be some reneging, where some of these companies say, look, I actually can't do this project. I know I had committed to this, right? It could be delaying. We've seen Oracle, as an example, do that a couple times, where they delayed the start of one project from 2026 to 2027. That's kind of flag number one. The big data center that they were supposed to have, Blue Owl helped finance for them in Michigan, that $10 billion project. Blue Owl starts to back out. And those are just kind of the early onset signs.
Core
But
Weave, same thing.
Core Weave, yep, same thing, right? You look at the credit default swaps of both of those, and they're through the roof. But the market, I think, is underappreciating, to your point that you made earlier. If we simply go from the expectation of we're going to build 800 data centers, but people don't even really understand what that means. Like, what would that require from an energy standpoint, that we are just not there, from a infrastructure perspective. But if we go from we're going to have 800 data centers to we're going to have 600 or 500 or whatever the number is, which, by the way, still may be way more than we need, right? Could still have unbelievable level of redundancy. Then the goodwill that has been imputed on some of these companies, it can evaporate very quickly.
Right. And the thing to watch, and I think you're one of the best financial advisors out there, because you have been coming into me for over 8 years about this type of question, is the financing of the data centers. So there's private credit in there, there's private equity, there's the banks. JP Morgan, great numbers. All of a sudden, stock underperforming on the earnings. Then look today, JP Morgan's trading at 2.6 times book, 2.6. Okay, the 30-year mean is probably like 1.6. Goldman Sachs today reported earnings 2.4 times book, 2.3. I'm telling you, in 2007, at the highest level of the financials as a percentage of the S&P, the most bullish sentiment in the history of the financials, Goldman Sachs was trading at 1.1, 1.2 times book. So Goldman Sachs today is at 2.1. So Goldman Sachs in 2007 was trading at 2.1 times book. Today, 2.3 times book. So even more expensive than in 2007. And you've got this risk to data centers. And if that slows down, then there's going to be this massive waterfall of bad loans because
Yep.
there's hundreds of billions of loans to support that build out. And if that build out slows down, those loans are going to sour pretty quickly and the financials are going to get really smoked.
So just real quick, this is one of the more of the cleaner setups here that I would say. But you've got Bank of America that they just reported earnings earlier this week that were like gangbuster. And the stock has just now gotten back to the levels that it peaked out at in late 2006, early 2007. No progress for almost 20 years here in the BAC, but it's sold off as it has hit those prior highs, coming into that resistance. And so just kind of an example there, Larry, of what you're talking about. But let me ask you this, and this is going to be our keyword that people are going to need to write in with emailing if they want a copy of the book here. The keyword is going to be malinvestment. Larry, you just hit on it, and one of the things that you taught me so much is that credit leads equities. What happens in the bond market is going to spill over and impact the direction of where stocks are headed. And so as it relates to this AI build out, that the private credit that has been generated to fund these things, that the malinvestment today is in the AI build out, yes or no?
100%. And Bill Gross has said that. And David Einhorn has alluded to that. David Einhorn did a beautiful write up on this. And it's really testosterone, guys. It's the Valley. I was in the Valley. We hosted an ideas dinner in San Francisco, and we went out to Menlo Park, met with some family offices. And one of the guys at the table said, Larry, you don't understand. Zuckerberg, Larry Ellison, they have no choice. They literally, it's like a gun is to their head to outspend the other guy. And
Mm.
return on invested capital means nothing. It's literally Dr. Oppenheimer and the atomic bomb, and it just doesn't matter to them. And whenever we've seen this in the shale revolution or in the dot com, whenever we've seen a rush to invest in, say, the global crossing, remember that you needed to have, the theory was that in order to have the internet, you needed to connect the world with copper wires, right? And so all of that build out in every single time in history we've seen this, even the railroads. It's just railroads did great over time, but there was massive booms and busts, and that's because of that testosterone. JP, there's a line in my book, right? Probably the best line for investors, that if you're a young person, you should write this on your wall and never ever look at it like once a week. JP Morgan, after the panic of 1907, said, there's nothing in this world which will so violently distort a man's judgment more than the sight of his neighbor getting rich. And
Mm.
that's so when someone sees Larry Ellison spending and someone sees Zuckerberg, okay, they're going to get rich. They're going to be the first ones. There's nothing in this world which will so violently distort a man's judgment more than the sight of his neighbor getting rich.
Mm. Yeah, and what that is going to lead people to do is take on a lot more risk than they need to, probably at the wrong time, right? They're Johnny come latelys to these things. I just want to connect the dots for everybody here on this malinvestment thing. I just want to highlight one of the areas that you talked about, this whole shale thing. Let's go back to the last real uh, bust that we saw was in the energy space, right? Money could have been borrowed for free post financial crisis because interest rates were basically so low. Energy prices were high. They were $120 a barrel. And people here in the United States and, Texas and, all throughout the Midwest, and you got the Marcellus up there in Pennsylvania, that they could go and they could put up gas and oil wells, borrowing the money for free. And even if their break evens on these things were $100 a barrel, they'd do it all day long. Oil was at 120. I'm borrowing the money for nothing. How can I miss? Right.
Right.
And what they never foresaw was we're going to bring so much product out of the ground. We're going to have so much supply that the price isn't 120 anymore. They forgot that these things are commodities. They're supply demand driven markets. We now have a tremendous amount of supply, and all of a sudden energy prices aren't 120 anymore, they're 60. Oh my god, we're underwater. A lot of those loans that were made to people that were wildcatting, going out and trying to find this product, are starting to sour. And then we know what happened. Oil prices, they collapse. And we actually saw crude oil prices on the May contract in 2020 go negative. That's when everybody was going bankrupt. And
And you and I were in there buying the energy names, and that was so
I know,
painful.
and I remember, like, it was a scary time, right? Because the calculus was you couldn't see any reason how things could actually go right. And when that's the case, like when you cannot even try to define the bull case, that's when you know, like, there's only a bull case in front of you. When you can't define the bear case, you need to watch out, because that means you probably only have a bear case in front of you. And so that's where I think investors need to be on their toes today, that so much money has gone into lending into this AI space because people feel like they can't miss. But you and I know that they can miss. And the reality is, we're already starting to see the signs of not the technology isn't going away, but if it just scales down from the 800 centers to 500, 600, there is so much goodwill imputed in these names that you said they can fall a significant amount. And the passive overdose that our industry has led everybody into, they are unwittingly taking on a lot more risk than they imagine. So, Larry, any final thoughts? I appreciate your time today. I know our audience does. Again, two-time best-selling author here. Colossal Failure of Common Sense, back in post-financial crisis. You definitely got to read that. I know that laid the groundwork for much of Larry's vision, and just enforced his experience to be able to pen this latest work. But Larry, any final thoughts as we wrap up for today?
Yeah, just I think that the commodity markets in the early stages of a multi-bull market, you've had the move in the metals. Um, Agriculture's been left behind. Coal, to some degree, has been left behind. Natural gas has been left behind. Um, so what we're doing is we're in our trade alerts, we're lightening, taking down the copper name, we're taking down 60% of our silver that we've had for 3 years. Painful going in, and we're broadening that. We're basically rebalancing the portfolio across the rest of the commodity sector. Uh, and there's a lot of great values out there. There's a lot of stocks that, like the Diageos, like the Targets, like the Nikes, that are trading at, you know, I mean, you can buy Nike ahead of the Olympics, right? Ahead of the World Cup. I think below the 200-week moving average. That you've had a number of bad quarters there. The capitulation score that we received in Lyondell, and Nike, and Diageo is up there almost with the great of all time was Exxon in November 2020 in terms of our capitulation model. But
Yep.
those three are up there, especially Diageo. And so
Yeah.
when
So
you
all of those names, interestingly enough, so we're working on a new scan here where we're looking for some of these dividend payers,
right,
um, and um, and a lot of these names, whether it's uh, Landau, whether it's Nike, whether it's Dow Chemical. I think the energy names. Throw this up here real quick, Spencer. So talking about something that is not in a bubble, right? But you're just talking about the energy sector as a whole, not even picking an individual name that hasn't gone anywhere for 19 years, Larry. And but is potentially on the verge of a meaningful breakout. And so if we want to be exposed to the commodities a little more, right? So first and foremost, investors, you can have exposure to commodities. There are plenty of commodity funds and ETFs out there that you can use to have exposure in your portfolio. And if you don't have exposure to that space right now, you probably should consider doing that on a structural basis here. Larry outlines a lot of that in his book. But for the companies that are involved in this space, here are the energy stocks. Ironically, Larry, here's what I think is interesting. The last times where you had the energy sector at these highs, okay, in August of 08, going into the Beijing Olympics, and this is when crude oil was $140, $150 a barrel. Here in 2014, when you had that false breakout, oil was getting back to about 120.
Right.
Well, we are pushing on those same levels right now. In crude this morning is at 60.
That's a brilliant point. Absolutely brilliant point.
It's at 60. Now, we're not here to dive into the business models for these companies and what they've done to make themselves more efficient and what they've had to do based on what this experience was right here back during COVID when oil prices went negative. But where is this not something that is it's way under-owned? I think you said it at the top of our discussion. The entire, oil and gas market capitalization, it's less today than it was, what'd you say, 10 years ago, right?
Yeah. 11 years ago. Yeah, it's 2.8 trillion versus 3.4, and it's literally 60% of just Nvidia, the entire energy sector.
Yeah, and it's like, look, if outside of the oil that we need to put in our car, the gas we need to put in our cars, the how we heat our homes, these types of things, that if we're going to actually bring on these data centers, even a fraction of the ones that they tell us that they're going to do, the demands that we have for something like energy are enormous. How can investors be not looking at the infrastructure of how we bring that to bear? But they have, ironically enough. But that is where there are risks in this market right now that people are either unwittingly exposed to, or they're just turning a blind eye towards them. That as many risks are out there that can befall them, there are opportunities out there, but it's going to require them to change the way that they're positioned. So, Larry, thank you so much for
Thanks for
joining
having us
today.
on. And right now we've been number 3, 4, 5, 10 on Amazon the last month. So really appreciate the support. The two books combined, we've now sold about 1 million copies. And I've been telling my wife Annabella over the years, as a former Lehman trader, if we sell 1 million books,
you're going to break even on your stock, right?
On our Lehman stock.
So you're getting there. Yeah.
It only
Congratulations,
took 17 years.
Yeah, congratulations. Cheers. Thanks
for being
brother.
here,
Larry.
Okay.
Thank you. Good
Bye-bye.
to see you. All right, everybody. The one and only Larry McDonald. I'm going to tell you, I feel so incredibly fortunate to be able to have connections to some of these people that, well, I'm a boy from Fayetteville, Georgia, and how I end up having a relationship with Larry McDonald, or JC Peretz or Steve Straza or whomever it is. I'm just blown away that I never thought that I would be able to have relationships and contacts like that. But but by the grace of God go I. So listen, everybody, thank you so much for joining us here today. Couple reminders. If you want the book, I got 6 copies of the book here that I'm going to give away. You got to send us an email to info@reveillewealth.com and use that keyword malinvestment. That is the entire the entire nature of this conversation. What Larry's book is a lot about, what our discussion is about today. These are the risks that are in front of this market right now. You've got to be attuned to them. I think I heard Larry say that some of these big names in the market, they could fall 50%. And when you comprise the largest weightings in the index, it's not great news for the index as a whole. I mean, I kind of have these like 2022 redo type vibes where the tech names, they fell a lot. The commodity names, they did really well. I'm not making any predictions there, but again, this is why we want to align our portfolio with the prevailing trends in the market. We also need to be looking at the intermarket trends, right? That graph that we had up there that JC showed last time, right? Where we're looking at the Mag 7 versus the S&P. This is a big deal. People are not positioned for things to go a different way than they have for the last 10 or 12 years. And when they do, Katie, bar the door. All right. Thank you again, everybody, for being here today. As always, give us a follow on Twitter, YouTube, and still we're trying to comprise the mailbag. Send us an email there, info@reveillewealth.com, with any questions that you want us to read here on the show and give you some advice about. But we're so happy, fortunate to be here. This has been the $1 Million Question. I'm Stephen Weitzel. We will see you next time. Take care.